Good day, ladies and gentlemen, and welcome to an introduction to CoreShares and the CoreShares multi-asset funds. My name is Chris Rule, and I head up the CoreShares product design and client solutions. And I would like to give you a brief introduction to CoreShares, an overview of some passive 101, and then take you through our multi-asset funds, which qualify for pension fund investments, provident fund investments, all pre- and post-retirement investment solutions as they are Regulation 28 compliant. So first of all, a big thank you to listening in to our introduction. But let me take it back a step. CoreShares as a brand is a business that started in 2015, but it has its roots going all the way back to 2007. And more specifically, the precursor to CoreShares was housed within the Grindrod group of companies and branded as Grindrod. So in 2015, CoreShares formed what we call a full-service asset management business, which really means we offer unit trust investments to clients, we offer exchange-traded funds to clients, and we do segregated mandates for large pension funds and so forth. We also have solutions from local to global and from single asset class to multi-asset class. So we believe we're truly full service asset manager in all senses and all possible senses of the word. And really what we stand for is an innovative business who is providing client-centric solutions that's backed up by a quality team and a really strong set of shareholders. So from at current, our assets under management is sitting at around 6.5 billion across various strategies from local equity to global equity and multi-asset funds, which is what we'll be chatting about today. But the growth has been very good since inception, where we're up to 6.5 billion. So a lot of talk around the world about businesses like ours, passive businesses or index tracking businesses, where really client centricity is at the heart of the value proposition, low costs, et cetera, et cetera. So I won't go any further, but to say that we believe that we have positioned ourselves uniquely in the market in terms of our product set and in terms of our core value propositions. CoreShares, I mentioned earlier, is underpinned by a really strong shareholding structure, which is straddled by these three well-known corporate shareholders and listed entities, or at least subsidiaries of listed entities. RMI, which is Rand Merchant Investments, their investment manager arm has a 25% stake in CoreShares. Outsurance, well known to most, but a majority-owned business within the RMI group, makes up the other 25%, and then Grindrod Financial Services makes up a large stake, 40% of their business effectively. So, the business is backed by large, credible shareholders who share the same vision as the management team in terms of building out a contemporary, modern, passive business that really looks to keep costs low and deliver great value to clients. So that's a very short introduction to CoreShares at a company level, but really what are we all about? We're all about index tracking. Now, index tracking is a bit of a buzzword, passive investing, another buzzword that's in the market. We really want to take it back to first principles and talk about what is an index and why does a business like CoreShares make a lot of sense for me as an investor practically. So we want to use a really simple illustration of what an index is. And an index can be something as simple as the JSE Top 2 Index. Now, this may seem like a ridiculous example, but you'll see how it helps investors understand exactly the value proposition of an index. So the JSE Top 2 Index is a small index that I thought of to illustrate to clients what an index is and what a market cap index is. So first of all, it would select the shares by size. So the two largest shares on the JSE, Naspers and Richemont in this case, would be selected simply because they are the largest shares. They would then be held in the index directly in proportion to their size. So in other words, the share with the largest market cap or the share who is the largest would have the largest weight in the index. So, for example, in this illustration, Naspers would be the largest share with a value of 20 Rand, and Richemont with a value of 10 Rand would be the smallest share. And so Naspers would have a larger weight in the index, 66.67% in the index, and Richemont 33.3% in the index. What do we do as trackers, as index trackers, being CoreShares an asset manager? How do we make this investment available to investors? Well, we quite simply go out and buy those shares in those exact weights and hold them either in a unit trust structure or in an exchange traded fund structure where you can access the underlying investment. So this is an extremely simple version of an index, and this is probably a more real version of an index. So this is a real index, the S&P South Africa 50 index. We track this index both in an exchange traded fund and in a unit trust. And we've got quite a lot of investors in it. We've got about 2.5 billion Rand invested in this index. And really what it does in a very similar vein is it buys the 50 largest shares on the JSE by free float market cap weighting. Now, free float just means that you will exclude double counting in the index. So where one share owns another share, you don't count it twice, or alternatively, where something is tightly held, either by management or by a holding company, that weight won't be counted because it's not available for purchase. So free float being another concept. So this just looks at the 50 largest shares by free float weighting, market cap weighting, and then holds them in accordance to their particular size. So again, the largest share gets the largest weight in the portfolio, all the way down to the tail where the smallest share gets the smallest weight in the portfolio. Now, this index does have something a little bit different where it caps the largest share at 10%. But that gives you an idea of what an index is. Other indexes that you'll be very familiar with are the JSE Top 40, the All Share Index, and in a global context, indices like the S&P 500, like the FTSE 100, etc., etc. So that's what an index is all about. So the question is, why own the index? I mean, that's really simple. There's so many clever guys out there. There's so many clever businessmen and businesswomen out there in the asset management world. Why would you buy this simple index if you could employ someone to select shares and outperform it? And the short answer is that it is extremely difficult to outperform this simple index. So SPIVA, which stands for S&P versus Active, is a 6-monthly review of the active managers in a particular universe. So all the active funds in, let's say, the CISA General Equity category who invest in South African listed shares. And it looks at how many of them outperform that very simple top 50 index. Now, what we find is that with professional asset managers, with professional managers, they really struggle to outperform this index. So we see only 7% of funds, and there are about 320 active funds, unit trust funds, which are in this category. Only 7% of them manage to outperform. 93% of them underperform. And now these, it must be said, are professionals. These are actuaries and accountants and CFA charter holders, and so on and so forth. So these are our very best talent in the market who are trying to outperform this index, and they really struggle to outperform it. But maybe this is just a snapshot in time. Maybe I'm being opportunistic with data. And over here, we illustrate that it's not a snapshot in time. It's relatively consistent through time. So on a 5-year backward-looking basis from December 2014 through to current, we see that active managers struggle to outperform the index. And this is a consistent theme that we see over and over again. The question is why? Why do these guys struggle to outperform these very simple indices? And a large reason is cost. Now, in this very famous quote, Warren Buffett touches on fees, but a large driver of future performance within a fund are the costs that are charged within that fund. So Warren Buffett very famously in 2013 said, "My advice to the trustee could not be more simple. To put 10% in cash and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy would be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." So I was paraphrasing there to an extent, but the point is that it is extremely difficult to outperform these low-cost funds, such as Vanguard's, or like we'll show you, such as a CoreShares fund. Now, this took the world by surprise, Warren Buffett probably being one of the most famous investors of all time, encouraging investors not to try and stock pick, which is what he has famously built his career on, but rather to buy the index. And a large reason why he suggests this is because a lot of asset managers out there charge extremely high fees, or charge at least high fees. And it detracts from your investment returns. Now, the impact of that in the short term may seem rather marginal, but in the long term, it becomes significant. And we'll get onto some a graph on that just now. So the question is, that's Warren Buffett sitting in the US. Would you apply the same advice locally? Well, we see a similar trend. We see active managers struggling to outperform. And if we look over the last 6 years of SPIVA reports with 5 years over 5-year rolling periods, we find on average South African active managers have actually been worse off than in developed and emerging markets. So we can conclude that it's reasonable advice in the South African market. But back to costs. Warren Buffett said, these high fee alternatives. And this really showed you the impact of costs on an investment over a long period of time. Now, Warren Buffett, the people who experience the best returns from Berkshire Hathaway are those who invested over long periods of time. So he understands long-term compounding like very few people do in the world. And this is the big challenge with high-cost active management versus what is typically low-cost passive management. Is on average, over the long term, your asset allocation will dictate your outcome or your long-term return. So let's say if you're 100% in equities, on average, you're going to get roughly the equity market over that long period of time. The big difference and what makes up the massive detraction in returns comes down to the costs. So what we've done is we've set a low-cost fund, which charges 0.5%, versus a high-cost fund, or actually what would be an average cost fund of 1.5%. And we're just trying to illustrate, this is an illustrative example, not a real-world example, of a difference of 1% in costs over 30 years. And the outcome is quite meaningful. I'm sure you would agree that in 30 years when you retire, you would much prefer to have 20 million Rand on the table than 15 million Rand on the table. And like any long-term compounding graph, you can see the impact in the beginning is marginal, and as you stretch that time horizon further and further, it gets more and more exaggerated. If you were to copy-paste this and say over 40 years, it obviously or naturally becomes more and more exaggerated over that period. So costs are extremely important. In fact, so important that Morningstar, who is a world-renowned fund manager research house, did research and concluded that costs are the single largest determinant of a fund's future success. In other words, it's the most important thing to establish whether a fund will be successful or not. It's not whether a fund has great fund managers, or even whether it's active or passive, it's whether it has low costs or high costs. And a low cost fund has a much higher probability or chance of being successful. So costs really cannot be emphasized enough in the context of pre-retirement, when you've got a long, I'm going to flip back, when you've got a very long time period to retirement, or post-retirement, where you are drawing down income and reliant on a net income amount, so income after costs. The question is, this is great, what happens in a crash? Doesn't active management add a lot of value in a crash? And the answer is yes. On a relative basis, there is an improvement. So from that 93% of underperformance, or on average 80 in the global financial crisis, but we saw more outperformers, so 39, but not meaningfully more. In fact, 61% still underperformed. So your probability that you underperformed is still better than outperforming. And if we look at the most recent COVID crisis, we see a similar trend. In fact, worse off where the active managers were close on 70% underperformed the index. So, the massive myth that exists out there is that the active managers, they add a lot of value in crashes, and that's why you hold them. And the reality is that simply doesn't play out in the numbers. So that was a little introduction into CoreShares and then into index investing. And you'll see a lot of this underpins our value proposition in our multi-asset funds. Now, our multi-asset funds are designed in terms of being compliant with Regulation 28. but they're also designed for particular goals in mind. So I'll touch on that very quickly. CoreShares in our multi-asset approach has an approach where we look at targeting two primary investment goals. The first being a wealth creation goal, and the second being a wealth consumption goal. If we very broadly split investors and individual investors, typically they're either saving up to accumulate wealth or they need to draw down on wealth because they're retired and they're reliant on an income stream. So they both have very client-centric and client-oriented goals. Now, CoreShares has a particular framework of multi-asset, but what overarches this entire goals-based approach is a renewed definition of risk. Now, this is not renewed by CoreShares. This is according to ISO, where risk previously was the permanent loss of capital. Risk is now defined as the effect of uncertainty on objectives. Now, the objectives in wealth creation are maximizing wealth maximizing wealth creation, but of course the objectives in wealth consumption are very different. So we'll get into some of the detail around the particular objectives of each of the individual fund. But more broadly, if we are wrapping our entire value proposition in this risk framework, this framework of defining risk of uncertainty on objectives, how do we at a granular level approach the problem? Now, the investment challenge is one which has been widely documented in academia. It's been widely documented across the world, in developed markets, in emerging markets, and of course in South Africa. And there are a few controllables, which we call our evidence-based investing framework, where we can rely on peer-reviewed, time-tested, and independent evidence to put together solutions that are more robust and that have a higher probability of achieving your goal. Or another way of looking at that is to say that has a less uncertainty in terms of the effect of risk on your particular objectives. So how do we do that? Within our evidence-based investing framework, where we look at these controllables, we have essentially four primary pillars. Those pillars are strategic asset allocation. Strategic asset allocation, according to Brinson et al., which is a famous research paper that came out, is the explainer of 90% of return variance in a portfolio. In other words, strategic asset allocation is actually the most important thing to get right in your portfolio. Stock selection and tactical asset allocation become almost irrelevant in the context of a 90% return variance explanation from strategic asset allocation. So that underpins both of our multi-asset funds, the wealth accumulation and the wealth consumption goal. Strategic asset allocation, understanding the asset class characteristics and how they fit together, how they not only fit together from a statistical perspective in terms of the correlations and the dynamics, but also how they fit together from a return objectives perspective, and of course how they fit together in terms of how they help clients achieve their goals. So if we can have an asset class that can create a higher certainty of goal achieving, or at least of achieving a client's goal, then that should be considered in addition to simply its statistical risk framework. The second lever that we pull on in our strategic asset allocation, in our evidence-based investing framework, is that of diversification. Harry Markowitz, a famous Nobel Prize winner, described diversification as the only free lunch in investing. And quite simply put, he said that because with a diverse portfolio, we can have the same expected return at a lower level of risk when compared to a portfolio that is not diversified, which has a similar expected return, but with much higher volatility and much higher levels of risk. So on average, on a risk-adjusted basis, we believe that a diversified portfolio, both geographically diversified, but also when we go all the way into the granular detail of asset classes, of sectors, and of single stock diversification, that it should be well diversified. So that's the second pillar of our evidence-based investing framework. The third is one that is slightly more theoretical, but we would know colloquially as smart beta. In the academic world, it's spoken about as factors. Essentially, what it is a systematic way of aligning clients' goals to particular portfolio objectives. So in the example of smart beta, there's two ways that we can look at it. In the wealth accumulation goal, we know that there are particular strategies or styles that over long periods of time should improve risk-adjusted returns for clients. And so we can apply those in a wealth accumulation goal. Equally, in a wealth consumption goal, we know that from an alignment of interests and alignment of goals, there are certain smart beta strategies that can align the equity portion of the portfolio very closely with the client need, which is to draw down income. So another well-researched, independent and peer-reviewed part of the evidence-based investing framework is this of factor-based investing or smart beta investing. And then, of course, that of fees. I spoke quite a bit about it earlier, and I won't hop on about it. But once again, Morningstar concluded that fees are the largest determinant of a fund's future success. So we know with absolute certainty that fees will be charged on a fund year in and year out, and that they will erode from the positive returns of that fund. So extremely important to ensure that all of these investment solutions are wrapped up in low fee funds. What don't we focus on? We don't focus on speculation. We don't focus on uncontrollables. Things like near-term market return expectations, macro events like Brexit, like Trump's coming into power, ESCOM, and in more recent history, things like Corona. Extremely difficult to predict, extremely difficult to understand how they're going to play out in the real economy and then translate into the capital markets, which would have an impact on our fund. So we don't focus on the uncontrollables. And we also believe that we should diversify as far as possible to reduce the risk of unforeseen company failure and so on and so forth. So we focus on our controllable aspects of asset management, and we try to ignore the noise. And that's the uncontrollables on the right. So what I'm going to do is take you through each of the funds at a very high level, very introductory level. We, of course, have a lot more detail on these funds, which we have on our website and which we can share with you if you request. But I want to take through some high-level stuff in terms of our goals-based multi-asset framework. The first one I want to look at is the pre-retirement goal, the wealth accumulation goal. And this is the CoreShares Wealth Accumulation Fund. We've got really quite simply two very simple goals. We want to maximize wealth creation. You want to, when you do retire, you want to retire with as much money as possible. That's the ultimate goal. And then secondly, we want to do this in a responsible fashion. As fiduciaries of clients' money and as responsible investors, we need to ensure we're managing risk. Now, this might sound silly. When you want to maximize returns, you should be taking on as much risk as possible. But the kind of example that I like to use is, let's assume you're a mountain bike rider and you're planning on going out on your favorite mountain bike trail and you want to do your best time on that trail. You've been training hard, you've eaten all the right stuff, your diet is in check, your fitness is good, you're feeling good. When you get onto that trail, the first thing you still do is put your helmet on. So, you ensure that you are managing the worst possible risk on a mountain bike trail, which is coming off and potentially seriously damaging, your head. So managing risk is not at the expense of ensuring great returns. Just like putting on a helmet, if you're going mountain biking, doesn't slow you down to such an extent that it's not worth wearing it. So we like to see risk management from a number of lenses, and we'll get into that. But again, looking at the overarching goal, which is to ensure that we maximize wealth accumulation. Within this, I wanted to show you two very simple illustrations about how we achieve these goals. So the first goal being maximizing wealth creation. When we look at the evidence, when we look at what asset class characteristics are like over extended periods of time, what we find is that equity gives us the best chance, or shares give us the best chance of maximizing wealth creation. How do we know this? We know this by leveraging off a world-famous data set known as the DMS data set, or the Dimson, Staunton and Marsh data set, over well over 120 years of data. In fact, they went on to write a book called The Triumph of the Optimists, which very simply concluded that it was the optimist who bought shares who was rewarded in the long term, and they triumphed. And essentially, if we look at the data over all of these rolling periods, over multiple long-term rolling periods, 7 years, we show that you are rewarded time and time again by being invested in equities. So we know within the goal of our multi-asset fund that we need a healthy exposure to equities. If we look at the numbers here, the probability of maintaining purchasing power by holding an equity investment or a share investment, a well-diversified share investment, is 89% to just beat inflation. If we look at investing in bonds, it's 63%. This is over any 7-year rolling window from 1901 to 2019. If we look at trying to achieve CPI plus 3 or at least beating inflation by 3%, we see it drops down to 75% for equity. But if we look at bonds, it drops even further to 36.9%. So in other words, only approximately 3.6 in 10 years will you beat inflation plus 3 by being invested just in bonds. And then if we stretch it out to CPI plus 5%, so a more ambitious wealth creation goal, if you will, we see that equities does it 65% of the time, but bonds only does it 29% of the time. So you do more than double your chance of achieving CPI plus 5 by being invested highly in equities than in bonds. So, understanding the drivers of return in the portfolio are extremely important in our evidence-based investing framework. The next thing I wanted to show you is how do we manage for risk in a reasonable way, in a sensible way, so that we can still maximize wealth creation, not detract from the wealth creation goal, but ensure that, when things do go belly up, when we have a COVID crisis, the proverbial helmet on your mountain bike trail is firmly on. And we do this through a number of different mechanisms, but the one thing that we do ensure we do is maximize diversification. And we maximize it by maximizing as reasonably as possible our offshore exposure within the constraints of Regulation 28. So we have a large offshore exposure. That offshore exposure is invested into a very well-diversified basket of equities predominantly, with over 5,000 shares referenced on the underlying, so extremely well-diversified. We make sure that we invest in all asset classes, from South African cash, South African credit and bonds, SA equity, and really what it is, it's that helmet. The example that I like to use, and it's a great example because it's recent and it's in our memories, is a lot of people would ask why we have global bonds, such a small share of global bonds in our portfolio. And the answer is simple. When we saw our market crash in the beginning of this year because of the COVID-19 pandemic, we saw global bonds in rands produce returns for the quarter ended 31 March of 31%. So they really were a flight to safety. The diversification of bonds really came to the fore. So it becomes the helmet, the effectively helmet on the portfolio in times like that. So maximize diversification at a geographic level, at an asset class level, and then at a sub-asset class level. What you'll see is that we ensure that we have single stock caps, so we're not overexposed to individual shares. In South Africa, Naspers has been a huge problem in index businesses where they've become extremely high weights, and we ensure that we are very well diversified at all potential levels of the portfolio. So those are just two very simple examples of what do we do, what do we ensure that we do structurally in our portfolio so that you can achieve your wealth accumulation goal. This is what the portfolio looks like in terms of its makeup. To give you an idea of the portfolio, the TER, or the total expense ratio of this portfolio, coming in at 0.53%. The average in the high equity category is more like 1.4%, so 90 basis points cheaper than the average. So over the long term, like I showed earlier, that makes a meaningful difference. We use every possible asset class at our disposal. We use credit, we use smart beta, we get offshore exposure, but importantly, we have a high exposure to growth assets. This is defined as equity and property, where we've got 50% in local equity, we've got 22.5% in foreign equity, and then we've got a total of 10% in property, both local and global, 2.5% global and 7.5% local. So we have a well-diversified portfolio here. What I want to touch on is that this is great, and this is what our asset allocation looks like, and you get an idea of how well diversified the portfolio is. But how does this look when we're looking at our fund. So what I did was I gave each of the characteristics of an asset class in terms of whether it was purely wealth creation or was it there for risk management purposes, and you get an idea of the kind of the balance that we're trying to achieve here, where the primary goal, the primary cog in this fund's objectives is wealth creation, which makes up around 82.5% of the underlying asset class return drivers. And this is achieved through lots of equity, through getting offshore up to 27.5%, through an allocation, healthy allocation to property, smart beta, active credit, and of course, keeping costs low, because we know if we keep costs low, we will maximize your wealth creation. How do we manage for risk? We diversify, we maximize diversification, and we do have an exposure to defensive assets, cash, credit, bonds, global bonds issued by global governments, and so on and so forth. And then, of course, risk controls and risk parameters within each of the sub-building blocks. So that's a very high-level overview of the Wealth Accumulation Fund to give you a good idea of exactly how it works. The next thing I'd like to show you is an introduction to the CoreShares Stable Income Fund. Now, this is a low equity fund. It is designed with the goal of retirement. In other words, it's designed for clients who are seeking out retirement or are very close to retirement. It has a 3-year time horizon attached to this fund or to this portfolio. So it has a very different objective to wealth accumulation. Wealth accumulation is the kind of fund that you would want to use if you have a long time horizon, if you've got a long time to retirement, whereas stable income is very much designed for the retirement goal, the actual drawdown in retirement and pre-retirement perhaps. So we're looking at the goals here, and the needs are quite different. The needs in this fund are not just wealth accumulation with a little bit of risk management, but they actually become quite real world needs. That's the need for income, essentially the need to replace your salary, the need to protect capital, the reality that when you are retired, when a client is retired, that they need to feel comfortable that their investment is safe, that they're not going to lose their entire portfolio in an event like COVID. And of course, probably the biggest risk faced by most retirees these days, given some of the marvels of modern medicine and the longevity risk, is that of inflation protection. Clients need to ensure that they are sufficiently exposed to growth assets so that inflation doesn't outstrip them and erode the purchasing power of their portfolio, of their money. So these are 3 very distinct goals which are specific to the post-retirement drawdown strategy that the fund aims to achieve. I wanted to do a very similar thing as to just explain with an income, what do we do? How do we try and achieve income? Capital protection, how do we do that? And then inflation protection, at a very simple level. And as I mentioned earlier, we've got far more detail on these funds if you do wish. So at an income level, we want to show the importance of cost when delivering income. What we did here is we took the low equity category, the CISA low equity category, and we split it up into quartiles, so into 25 percentiles. And we looked at the relationship between cost and net income delivered to clients. And what we found was that the funds with the lowest fees very simply delivered the highest levels of income, regardless of the fund mandate, regardless of the speciality that a fund manager was claiming to produce. And let's say they were claiming to be an income-focused manager or a manager who could deliver more income. If they charged a high fee, on average, they delivered low income. And if they charged a low fee, on average, they delivered more income. So we see that the low fee managers deliver consistently more income. In fact, we see a negative correlation between TER, or total expense ratio, costs, and net income of negative 96.7%. Now, it is tempting for me just to keep it at that. It's a correlation, but actually it's causation. It's causation because net income is low as a function of high TER, and net income is high as a function of low TER. So in fact, it's a causal relationship, and it shouldn't come as any surprise to investors. However, we needed to reiterate that when you are retired and you're reliant on income, it's important to have an eagle eye on the costs in your portfolio. So how do we do that? Well, we quite simply charge a low fee. We charge a fee of, let's say, roughly a TER of 50 basis points relative to the average of, say, 1.5%. The other way that we can target income is by aligning our equity portion of our portfolio with the client's need for income. So by using, in this instance, smart beta and a dividend aristocrat strategy. Dividend aristocrats is a smart beta strategy that CoreShares has been running for well over 5 years now. And it is a strategy that targets companies who have track records of sustaining and growing their dividends. And what you can see here is that the real track record, what it shows is that Dividend Aristocrats has delivered more income than 96% of ASISA General equity peers over a 5-year period. And you can see all the disclaimers that this assumes you invested R1 million and you drew all of your income and didn't reinvest it and so on and so forth. But the point is that by using Smart Beta, we're able to target high levels of income and growing income. And of course, by wrapping this all up in a lower fee, a structurally lower fee, we're able to deliver more cash to clients by taking less fees for ourselves, very simply put. So achieving income through low fees and through using things like Smart Beta. We also use active credit, which I haven't touched on, but it's another way that we get allocation to income generation. Then we ensure to protect capital. We ensure we've got more exposure to defensive assets. So in the wealth accumulation goal, you would have recalled we had defensive assets only around 17% of the fund. Here we've got more than half of the fund invested in what we would call defensive assets. These are the assets that are highlighted in blue. So South African credit, South African cash, South African bonds, South African inflation-linked bonds, and global bonds. So our best capital protection strategy is to ensure that we've got sufficient allocation to these defensive assets, but also that we diversify as far as possible at an asset class level, at a sector level, and so on and so forth. So using sufficient exposure to defensive assets, and by diversifying, we can ensure that we can protect capital through in the short term. But importantly, on the inflation goal, and I wanted to touch on that, is that it's in many respects as equally as important as inflation protection, as capital protection. We need to ensure we've got sufficient exposure to SA equity. So if we go all the way back to our primary risk was the effect of uncertainty on objectives. In other words, the effect of how we invest our fund on our final goal. And if we don't have enough exposure to inflation-beating assets, we're not going to achieve the goal of inflationary protection. Equally, if we don't have enough exposure to capital protective assets, we won't protect capital, and so on and so forth. So really important to understand the relationship between the different goals and how we use asset classes to achieve those particular goals. At an asset allocation level, this is kind of a traditional asset allocation graph that you would have seen. You can get a feel for where we have a more balanced asset allocation or a more conservative asset allocation. We've got more allocation to local cash, for example, to short-term credit and short-term bonds. We have a healthier exposure to local nominal bonds and global bonds. Again, global bonds being the proverbial helmet, but some of these other asset classes are further protection. So, this is the kind of mountain bike ride that you go out on, and you're putting on knee pads and elbow pads, and you're ensuring that you've got your helmet on, but you've also got your gloves on. You're just being more conservative in this portfolio. You're ensuring that you've got more asset classes which are defensive in nature. But the idea here is that we achieve the 3 primary goals. We achieve income, we achieve capital protection, and we achieve inflation protection. So we have the portfolio here has a higher starting yield and has more exposure to defensive assets, but still healthy exposure to growth assets of 47.5%. Again, moving out and moving into the goals, what I wanted to show you here is that when we look at the 3 primary goals, which have very close to equal importance in the retirement challenge, we wanted to, again, in a similar way, tag each asset allocation decision to a goal and what the characteristic of that asset class is. So, for example, let's take an asset class like cash. Cash is a fantastic income generator, but it's also a fantastic capital protector. So they can have different characteristics. And when we grouped them and weighted them according to their characteristics, what we found is a really well-balanced portfolio where 34% of the portfolio, if we categorize it like that, is intended and has a particular goal of income generation, 36% of inflation protection, and 30% in terms of some capital protection. So important that all of these cogs are pulling together and almost have equal importance. We wouldn't want to see a portfolio which was focused solely on income generation or solely on capital protection at the expense of the other goals. So it's a solutions-based approach. It really is a goals-based approach. And the most important goal is that we are achieving high and sustained levels of income, that we are protecting the purchasing power of the portfolio, in other words, inflation protection, and that when there is a crash, we're providing some downside protection. We're providing some comfort that the portfolio is suitably diversified and has suitable exposure to defensive assets that you, as an investor, can sleep well at night. So that's the CoreShares Stable Income Fund. TER of around 0.5%. That obviously contributes to the income goal, being a low-cost investment. So that's a simple wrap from us. Essentially, in a very summarized way, we've got, in terms of your retirement needs, we've got two primary goals. One is you've got a long way to go to retirement. I would say, let's say, 5 years or more. So 5 years, 10 years plus. The wealth creation goal is a suitable investment in terms of those kind of time horizons. It is what it's intended to in terms of the investment mandate. So that investor looking at a wealth accumulation goal, maximize wealth creation. And then as you near retirement, you start thinking about drawing down income. You start thinking about capital risk, etc. The Stable Income Fund is positioned to not only generate salary replacement and growth and capital protection in retirement, but also as you transition to into your retirement, you could start allocating more and more money into a strategy like that. So if there are any questions, please feel free to shoot us a question on these two new multi-asset funds. As I mentioned earlier, they're Regulation 28 compliant. They're available on most LISPs in the market. We do have specific lists of the LISPs. If you need access to these funds on your platform, just give us a shout. We'll chat to the platform administrators and see what needs to be done. But we look forward to engaging further with you, and we look forward to serving our investors in terms of their two primary goals: wealth creation and then wealth consumption. Once you've saved all your money, then you're essentially going out to spend it and to live off it, and that's the primary goals of investing. The last thing would be, if there are any general queries, so please drop us a line at info@coreshares.co.za, or as I mentioned, get in touch with the administrator and we can chat to them. So thank you very much for your time.